There are 3 steps in the ultimate trading formula: analyze, strategize, and monetize. In this video, we're going to cover the third piece, monetization. If you need to catch up on the first 2, I'll link to those videos in the description below. Monetizing your trading is really a conversation about risk management. Most traders hate talking about it, but you'll find that the pros live by this. You might even go as far to say it's their secret to success. Now, off the top of your head, you can probably think of several ways to manage your risk. Things like stop placement, hedging, options, dollar cost averaging, and more. But before we jump into the details, one of the best and easiest ways to avoid losing money trading is to participate in our funded trading program. Please, for the love of everything important in your life, you don't need to risk your own money trading. I'll put some additional details about funded trading in the description below. Now, as we think about monetization of your trading or risk management, I'm going to introduce you to one of my most valuable principles. To begin, let's start by considering the difference between return on investment and return on risk. Most are familiar with return on investment. It's the amount of money you make compared to your total position size. Return on risk, however, is the money you make compared to your loss limit. For general purposes, we'll consider that to be your stop. Here's an example on Starbucks. Starbucks is trading at $88. It's in a nice uptrend, and so you decide to buy 10 shares, costing you $880 total. That's an investment of $880. Now, Starbucks continues on up to its target, achieving $98, and our position is now worth $980, and our return, therefore, is the difference between $980 and $880, which is $100. And your return on investment, therefore, is about 11.36%. Now, return on investment isn't a bad idea, but it leaves us with some unanswered questions. For example, how do I consistently determine the number of shares I should buy? Do I just push my whole account in on every single trade? Should all trades even be considered equally, regardless of how far the stop or the target might be? Or what if my current win-loss streak is below my standard? Should I even still take this trade? Let's rewind this example on Starbucks and take a look at it from a little different perspective, a return on risk perspective. When we entered Starbucks at $88, we could have had the opportunity to place a stop at $84, effectively limiting our loss to $40 on this entire trade. Starbucks, of course, achieves $98, making our position now worth $980. The return remains the same, it's $100, but our return on risk is actually 250%. Now, I don't care that the percent skyrocketed, but what's more important is that this is the foundational principle for what I call the R's system of risk management. Which reminds me, what state did the pirate call home? Arkansas. R is simply the abbreviation that we use for a unit of risk and reward. The R value is a standard. It's independent of the size of the stop. To illustrate this, let's go back to our example on Starbucks. I've backed up the example to where we got into this trade at $88, but I've now notated our stop at $84. We can illustrate this using one of my favorite tools. I call it the box tool. In this particular example, the size of our stop is $4, and therefore the size of our box is $4. But instead of calling it a box or a stop, all we're looking at is the R. The R on this particular example is $4. Not only can we look at the stop in terms of R's, but we can also look at our target in terms of R's. As we stack box on top of box and we watch Starbucks go up to $98, we can say our target was 2.5 R on this trade, or 2.5 boxes. Now let's expand on this idea and consider how this could guide our position sizing. I would suggest that on any given trade, you risk no more than 2% of your entire trading account. 1% is even more conservative, and that's typically where I trade. So on a $20,000 trading account and a 1% risk limit, you can afford to lose on any given trade $200. As a side note here, if you begin to have a poor win-loss ratio, I encourage you to reduce the size of your R. Let's go apply this to our Starbucks trade. Imagine you've got a $20,000 trading account. Our stop is $4, as we've discussed, and our maximum allowable risk unit, the R, is 1% of our account, or $200. We're going to assume, for the sake of this example, that your win-loss ratio is acceptable. The question is, on this trade with a $20,000 trading account and a $4 R, how many shares can you afford to buy and not lose more than $200? Go ahead and type it in the comment section. If you said 50 shares, you're correct, because 50 shares that each lose $4 are going to represent a $200 loss on this particular trade. Now, there's many benefits to ours trading, not the least of which is that it removes the emotion associated with risk. We're not making or losing money, we're just trading ours. It also scales well as you move into larger trading accounts. And the system is extremely forgiving as it can expand and contract based on your personal trading performance. It also creates an excellent foundation for future advanced trading strategies. You now know the complete ultimate trading formula. You have all three of the required pieces: analyze, strategize, monetize. On this channel, we'll continue to dive deeper into those topics along with regular market forecasts, so be sure to subscribe. And for information on our funded trading accounts, reach out to us at the email in the description. Blessings and favor on your trades as you go forward. I hope that you put fat stacks of cash in your jeans.